This week on Wealth Track, investor protection specialist Pat Huddleston arms us against financial scams. Retirement income security specialist Chris Blunt beefs up our retirement income. And dealer Patrizia DiCarobio picks jewelry that will last a lifetime. Next on Consuelo Mack Wealth Track.
Stocks rose sharply yesterday, driven by reports of good earnings.
Opportunity favors the prepared mind. BlackRock.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Do you remember the quote from Hamlet, "When sorrows come, they come not single spies, but in battalions"? Well, it may seem like a stretch, but if you are one of the investors affected by the multitude of recently uncovered financial scams, you too might be feeling under assault. Well, we're going to talk to a former SEC enforcement chief, now investor protection expert, about how to avoid such a fate. Another potential tragedy unfolding is the possibility that millions of Americans could outlive their savings. Now, as demographer Peter Francis told us on a recent Wealth Track, recent retirees and older are the fastest growing segments of the population. The number of 65 to 74-year-olds is increasing at an estimated 50% plus rate over the next 10 years. And the 75 plus crowd are next in line, with their population estimated to grow by 20%. Many of them are women. Yet because of their longevity, retirees face more challenges than ever before. A healthy 65-year-old man has a life expectancy of 85, but a 50% chance of living longer and a 25% chance of living beyond 92. On the other hand, a healthy 65-year-old woman can expect to live till 88 years old and has a 50% chance of living beyond that, and a 25% chance of living beyond 94. Now, if you combine these ages with the decreasing levels of return expected from Social Security and the demise of the traditional defined benefit pension from companies, you have what retirement experts call a perfect storm. What can we do to protect ourselves? We're going to get some answers from New York Life's retirement income security expert, Chris Blunt. In recent years, investors have been turning to tangible assets to boost investment returns and provide some financial security. Well, up until this year, art, diamonds, and fine jewelry have done the job, but not this past year. According to one report, 2008 will go down as the year the big stone bubble burst. Prices of 3-carat plus diamonds fell by about 15% in the final 3 months of last year, and in some cases, trade was so slow that those prices don't really reflect the market's weakness. We'll ask jewelry dealer and appraiser Patrizia DiCarobio for her outlook. Protecting yourself from financial scams, outliving your retirement income, and poor jewelry choices are next on Consuelo Mack Wealth Track. How can you protect yourself from the explosion in financial scams, running out of retirement funds, and yes, even bad jewelry choices? Well, our first guest is the CEO of Investors Watchdog. It is a private investor protection firm. Pat Huddleston served in the enforcement division of the SEC, leading investigations of cases involving Ponzi schemes, insider trading, and brokerage firm misconduct. And to help us make the most of our retirement funds, we are joined by Chris Blunt. He is Senior Vice President of Retirement Income Security at New York Life. Chris is in charge of annuities, long-term care insurance, and the distribution of mutual funds at New York Life. And to find out what's happening in the market for gems and jewelry, we are delighted to welcome back Patrizia DiCarobio. Patrizia is the former head of Christie's Jewelry Department. She is now a private dealer and gemologist at her own firm under her own name. So welcome to all of you. It's great to have you here on Wealth Track. And Pat, I'm going to start with you because, you know, there's a saying, as the tide runs out, that all of the naked swimmers are revealed, and it turns out in this bear market and recession, we are seeing more instances of scamsters revealed as well. So, but how do we spot them in the first place, and specifically, how do we spot them as individuals?
Tough question. You need help to do it. That's what's important to know. Psychiatrists tell us that every healthy human walks around with a natural optimism that helps us navigate everyday life. Unfortunately, what that leads to when you're making an investment choice is that you think the disaster scenario is never going to happen to you. It's always going to happen to somebody else. So on the one hand, you've got this great return that you're chasing, and just because you're a healthy human, you tend to minimize the disaster scenario. So first of all, know yourself. Understand that just by the fact that you've got that tendency, it's going to be very hard for you to do it by yourself. But the other thing to keep in mind is don't look for the stereotype.
Yeah.
There was a great...
So I wouldn't have known necessarily. What would you have known if you had seen a Bernie Madoff or an Alan Stanford? What stood out would have stood out to you that would have gotten your little warning signals going off?
Yeah, what I would have known from my SEC experience is the lack of transparency is very, very troubling.
In their firms.
Exactly. Yeah, I would have warned people away from it based on that alone. The returns, unrealistic returns over a period of time when the market was down and they somehow managed to have fantastic returns, that just doesn't happen. And then you take a look into their backgrounds. First of all, with Stanford, he's operating offshore.
Right.
And, he's offering certificates of deposit, which I think you're going to see a lot more of, geared to people who really want safety, and who doesn't want safety in this time. So, and with Madoff, obviously, he had a broker-dealer that he controlled, so there was no independent oversight over his operations.
Right, and he also he generated his own statements, right? So is that another sign of a possible scam? If there's nothing outside that's monitoring
that's absolutely
that
right.
individual or that firm.
Yeah, it's almost cliche now for us to see phony account statements in these cases.
Yeah. I want to ask each of you basically some of the same question. This is not your area of expertise, luckily, but Chris, in the retirement income area of annuities, for instance. I mean, are there warning signs too if someone approaches you with a product that you've seen in your experience?
Sure, I'd echo a lot of the same things that were said. Transparency is critical. If you can't understand it, I often say if you can't explain it to your mom, then it's probably not a good investment for you either. So I think that ability to actually understand how it works, how the returns are being generated. So the mere fact that someone's generating returns and they can't explain it to you, or they're unwilling to explain it to you, probably ought to be the first flag.
All right, so that's a really good point. And what about in jewelry, Patrizia?
So I'm going to say a little differently than all of you,
right,
because I think very few people really know my field, and particularly the high-end jewelry. But certainly what I always said is you have to buy from someone you trust, because I don't think you can show it to your mother and your mother could say yes or no, except if it's beautiful or not. But you have to really buy it knowing that what you buy is what you are told you are buying.
Especially if you're dealing with private dealers.
Exactly. Right. I would say even with the auction house.
Yeah. Okay.
Even there, you may have things that are signed and could be sometimes discussable.
Right.
I don't think anyone will tell you a weight that's not the right weight. But, there is so many things, so many details that can make a big difference.
All right. So it's caveat emptor, I guess in all of these fields.
Yeah.
But particularly, in finance. And when I think of, Pat, that a lot of very smart people got involved with Bernie Madoff, for instance, and so that everyone else assumed that somebody else was doing the due diligence. But, what, didn't ring true to you, or were there things that didn't ring true to you as far as the individuals themselves were concerned? I mean, we talked about kind of what they were offering, but Alan Stanford is a very flamboyant person, Bernie Madoff less so, but you said that there are characteristics in scamsters. So what are the tip-offs?
Yeah, they tend to be extravagant spenders. I mean, they're oftentimes on the boards of charitable foundations. They oftentimes give heavily to their church or their temple. And some guys like Stanford have a stable of race cars. Other guys like Madoff collect houses. But you're going to see him giving heavily to charity. You're going to see him giving heavily to educational institutions. And look, they're not using their own money to do it. Why not, right?
Right.
I mean, for them, it's about being the big man And so they're going to get out there and they're going to spend money in a way that attracts attention.
So they can be flamboyant, they're conspicuous consumption.
Sure.
I mean, you know, there's one other thing that's kind of the level of trust as well. That, I mean, you said we're all optimists, so these are salesmen as well, right?
They are, yeah. And picking up on what Patricia said, I mean,
Right.
she said you have to buy from somebody you trust. That's the whole game here. The market, or the industry, weeds out people who don't engender trust. Everybody you meet in this industry is going to be somebody who you instinctively trust. They just have that charisma gene, or they have that ability to talk to people. And so that is what is so fundamentally challenging about protecting yourself in an industry that has a lot of terrific products and a lot of terrific people, but also if you pick the wrong one, it can be disaster. You can be wiped out.
You know, Chris, trust is an issue now that is very much, you know, it's been shaken really severely, especially in financial institutions. And, you know, you come from a very strong life insurance company, New York Life. But, you know, when you're buying insurance, for instance, I mean, we're hoping and we're trusting that the institution is going to be around for 30 years from now to basically pay off the insurance. So talk to me. I mean, you know, who can we trust in the insurance industry? I mean, you know, what do you look for in an institution that we think will be around for another 30 or 40 years?
Yeah, it's a great point. I mean, you hit it on the head. These are obligations. If you think about it, these are IOUs. Any insurance contract is an IOU between an institution and an individual. In the case of life insurance or an income annuity, it's an IOU that may have a 30 or 40-year shelf life.
Right.
So I'd say things, longevity would be one. How long has the company been around? I mean, nothing speaks more loudly than a track record of meeting your obligations. That would be one. Clearly, you want to look at the financial strength of the company, and so a lot of people will turn to the rating agencies, although there are others that feel that the rating agencies haven't distinguished themselves.
Right, that they've really failed in a lot of respects. Now, AM Best, for instance, you know, will rank insurance companies. I mean, I don't know, has AM Best been tainted by the problems with the ratings agencies, or?
Yeah, I don't think specifically there, and
Right.
and you know, a lot of the issues around the ratings were in other areas. It was rating these very complex, back to the explain it to your mom comment, you know, they were
Right.
rating very complex securities that I think even they themselves thought they understood, and it was apparent that they didn't fully understand them. But, you know, back to the companies themselves,
Right.
you know, the other, which, you know, we've spoken about before, is this notion of, you know, who are you trying to serve? You know, we happen to be, New York Life is a mutual company, meaning we're owned by our customers.
And explain why you think that's important. And I don't mind you speaking, you know, kind of talking your own book, but you know, the difference between a mutual insurance company versus a publicly traded insurance company.
Sure. In essence, it's very simple. You know, a mutual company really serves its policyholders, so the owners are the clients, if you will, own the company. You know, a stock company similarly is trying to serve its clients, but it has another constituency, which is being a public company, it's trying to keep Wall Street happy,
Right.
and it has an obligation to shareholders.
So you think the difference is in how they operate the business. What would you say the difference is?
Well, I think the biggest one is the time frame issue that we came back to.
Right.
You know, it's difficult to run a company with a 30-year, 40-year mission, as is the insurance business, or in our case, a 163-year mission, and at the same time try to keep Wall Street analysts happy that might have a 30-day mission or priority. It's a difficult thing to do.
All right. You know, Patrizia, you know, we mentioned that the diamond market has declined and how little liquidity there has been, very similar to the credit markets, as a matter of fact, for a while in the past couple of months. So what about the secondhand jewelry market? How has that held up?
It has done, I would say, much better than the diamond market.
Right.
We still have seen a decline in trading and a decline in prices. But I would say maybe if I say 20% at the most in decline of prices, and not always. And in decline of trading, everything is slower. You know, it used to be very flowy and things would come and go. And today, you may open your safe and see the same things several days or several months in a row. So that's what's different.
So now the financing, I'm assuming, has also dried up, right, for dealers?
Definitely.
Right.
But I would say in this industry, a lot of people are not financed. So the ones who are not financed obviously are the best off because they can open the safe and feel at least they can look at pretty things and know they own them and know that if they need the money is there. It may not be as much, but it certainly is there. There is no doubt in your mind.
Yeah. So, you know, Pat, what kind of scams are we seeing now, or what should we be aware of? And my understanding is that, again, people who participate in scams, they're pretty current. I mean, right? There there are hot products, and they jump on those hot products. So what's hot now?
That's it. It's all about establishing credibility for them, and they do that by directing you to the newspaper. They know you've been keeping up on the news, and so if gold is up, you're going to see gold scams. People want security now. You're going to continue to see CD scams. When gas was $4 or $5 a gallon at the pump, you had oil and gas scams going. And listen, in the stimulus package, I think there's several $billions to promote use of alternative energy.
Yes.
You're going to see a lot of alternative energy scams. The population is aging, and so you're going to continue to see a lot of healthcare scams. I mean, whatever they can find in the news, whatever they can grab to add to the mix that they're using to try to create this aura of credibility, they're going to use.
That's what they're going to use. So, Chris, one of the things that we're all facing as investors, and especially retirees, is the decline in the value of our retirement portfolios. So what are you telling clients when they come to you and say, I've really suffered these losses? What can I do? I mean, how can I possibly make up, what I've lost?
Sure. Yeah, obviously this is a very difficult scenario for people. And I guess the first question is, what is your time frame? So if it was someone in their 20s or 30s, I would say stay the course. His history is with you here, and be patient, et cetera. I think the challenge is more for those people that were on the bubble, either in retirement or, in some cases even more dangerously so, right at the edge of retirement, right? And they're perhaps, late 50s, early 60s.
And they're particularly vulnerable. Why?
Well, if you think about it, when you're younger, time is your friend. Right. You can make a lot of mistakes, and time will cure all. As you get older, time is not your friend. And so, if you've got time, equities do have a tendency to come back. If you don't have time, we would recommend things more along the lines of immediate annuities, for example. You talked about longevity, but trying to give people some form of guaranteed income and try to project them against the issues of, outliving their assets.
But, talk to me, because I know that there was some Wharton professors have done some studies on annuities, on income annuities. So just tell me what the research finds, that in fact, with a smaller amount of money, evidently, you can get more bang for your buck. So tell me how that works.
Yeah, two professors, David Babel and Craig Merrill at the Wharton School, did some research looking at income annuities, when someone gives a lump sum to the insurance company and they get a paycheck for life back, essentially. And what they found was very interesting. For somewhere between 25 and 40% fewer assets, you can generate the same level of income guaranteed for life that you could with a regular mix of stocks, bonds, and cash.
And why is that? Why does it work out that way?
Yeah, it's really what, they refer to the magic of risk pooling, but at the end of the day, obviously we know it's not magic. It's, as an insurance company, we can assume that you live to life expectancy. So the stat was given before of, say, age 85.
Right.
As an individual, you can't take that chance. You don't want a 50-50 chance that you may live longer than that. So you probably have to pack in some sort of a cushion. And you can't guarantee it if the underlying investments are stocks and bonds. So it's really through that vehicle that the insurance company can actually give you a higher payout, because at the end of the day, half the people live shorter expectancies and half live longer.
Oh, it's 50-50 about? All right. So that does work to the benefit of the 50% that live.
Correct.
No, exactly. So, Patrizia, you're wearing some gorgeous jewelry, and so let's talk about some jewelry that you think will hold its value, and let's start with that brooch on your
So the brooch
dress,
on
which is gorgeous.
It was made in the 50s, I would say, by a man called Simon Chaps, who still exists. He was in New York. And what he did was really collect odds and ends and make it into jewelry. So he took the inspiration from what he found in nature. By example, this is a piece of coral that probably he found in, some place in his travels, and then added and created this flower piece. Now, this is unique, one of a kind. So if you own it, the chances are that whenever you need to sell it, there will be a market for it, right? Instead, if you were to buy something that's made in 100 or 1,000 or 100,000 or whatever else. So here, intrinsic value has very little relationship to the actual piece itself. Okay?
All right. And so it's signed?
It's signed.
I mean,
it's
how old is it?
At this point, 40 years, 40 plus, probably almost 50.
Right, and so does that make a difference as well?
Yes, definitely. And again, if jewelry being something that you wear, there is fashion also.
Right.
So right now, this is fashionable. Maybe 10 years from now, this is not at all fashionable and something else will be. So that could also change the value.
Right.
Right, or at least how much is desired. But definitely, I would say, because workmanship is not as good, because raw material is not as available, whatever you have now can only, in the long run, increase in value.
All right. So speaking of value and the long run, it's time for the one investment for a long-term diversified portfolio that I ask each of you to suggest. And you know, Pat Huddleston, it's not an investment, but it really is an investment in your time of who you can trust. So what are you recommending that we do?
You have to know who it is that you've given access to your life savings.
Right. So check out your investment professional.
Yeah, you need to invest in finding out who they are. And if you don't want to do it through an investor protection service,
right,
do the investigation yourself. You can get some information from FINRA.
FINRA, the Financial Industry Regulatory Authority.
Right. Although that's going to be incomplete. Better information probably from your state securities regulator. And then you really need to know the background of somebody, and you need to investigate state to state wherever they've lived to find out if maybe they were involved in a scam while they were unregistered and living in a certain state. That's the minimum that I would do if I were recommending somebody
right.
to my
So that would take a lot of work,
it would.
Needless to say. But I mean, would you say without a question that anyone who has a broker or a financial advisor should check them out? I mean, do you think that's just kind of a minimum thing that we should do?
Yeah, most certainly. I mean, we're just
even if they work for a reputable firm, or
even if they do, yeah, we see cases all the time of brokers who are
right.
selling things outside the firm, and
all right,
yeah.
You know, that's probably in this day and age. You're absolutely right. Chris Blunt, you're looking at income, and we talked a little bit about it before, but why would you have us buy an immediate annuity?
Sure, I'd say for two reasons. One, you know, there's so few things that are guaranteed today. So I would say it's really the only vehicle other than Social Security or a pension plan that can give you guaranteed lifetime income. And
right.
I think for most people that plays a place. But I would also say today it can serve two possibilities. One, if your assets are down, you can, in essence, almost recreate that same level of income with fewer assets by using one of these vehicles. But maybe more importantly, I think having something guaranteed, having an anchor in your portfolio, allows you to be a bit more courageous with the rest of your portfolio. And
right.
this is a period where we all need a lot of courage.
And I'll say that you would recommend only one that's issued by a AAA rated mutual insurance company. I mean, that's basically, those are your guidelines.
Yep. Once again, it's a long-term paycheck.
Right. And Patrizia, lasting value in my jewelry box, how do I create it?
You create it by buying signed pieces, second-hand versus probably first-hand.
And the reason second-hand?
And the reason second-hand is because when you buy it, you don't pay for the full value of the workmanship. And because you buy, in general, unique or much rarer. So the long term will be faster.
All right. And the other thing is you should love it.
And the other thing, you should definitely love it and want to wear it. What are you better off with, a piece of jewelry or a piece of paper in your hand, right?
Good. Exactly. Do you understand this? I don't.
Or use the extra income to buy some jewelry.
No question about it. All right. Well, thank you all so much for joining us on Wealth Track. Pat Huddleston from Investors Watchdog. It was really great to have you on and meet you finally.
Thanks so much.
And Chris Blunt from New York Life. Great to have you here as well. And Patrizia DiCarobio, thanks so much for rejoining us on Wealth Track. Well, at the conclusion of every Wealth Track, we try to leave you with one action to take to build and protect your wealth over the long term as well. And this week's action point picks up on Chris Blunt's recommendation. If you are retired or very near retirement, do consider buying a fixed immediate annuity. Now, we've talked before about the importance of having a guaranteed income stream to take care of life's essentials when you've retired. And an annuity does that, and does it for less money than a mix of stocks, bonds, and cash, as we just said. The insurance company can do this because it puts you in a retirement pool where the company assumes the risk that you live beyond your life expectancy. You continue to receive payments all of your life, no matter how long you live. And as Chris said, those who die earlier than the actuarial tables predict effectively subsidize those who live longer. So for a 65-year-old male, a fixed immediate annuity with a life-only option, a lump sum of $100,000 will pay out $690 a month for life. Now, that's a payout rate of 8.28% right now, and it's guaranteed. Now, if you live to age 85, you'll have received over $165,000. If you make it to 90, you'll have gotten more than $207,000, which is not a bad deal if you live to a ripe old age. Now, there are downsides to annuities. In most cases, you are locked in for the duration, and if you build in more flexibility, such as extending the payout to a beneficiary, you decrease your monthly income. So it's best to keep it simple, keep the fees low and the payout rates high. and make sure you buy your annuity from a financially strong insurance company that will be around for many years to come. And you might want to add an inflation protection rider so you don't fall behind future increases in the cost of living. And we've run out of time for this edition. Next week, we're going to feature two promising investment sectors and the men who follow them. Tom Russo invests in a small number of elite global brands, and Bill Paul writes about alternative energy. We'll find out from both of them where there is money to be made. Until then, to watch this program again, go to our website, wealthtrack.com. Starting on Monday, you can see it as a podcast or a streaming video. And while you're there, check out our WealthTrack bookshelf for our recommended investment reading list. Thanks for visiting with us, and make the week ahead a profitable and a productive one.
Opportunity favors the prepared mind. BlackRock.